हेलो फ्रेंड्स, वेलकम टू लर्निंग सेशंस। और आज के इस वीडियो में हम बात करने वाले हैं बेसल 3 गाइडलाइंस के बारे में। सो इफ यू आर प्रिपेयरिंग फॉर द BFM, लेट मी reiterate the same to you that the module B is the most important module and the second most important module is module A. We have started with the module B and thereafter we are going to cover the module D and then we'll be covering the module A and C, right? And these all modules are important, but module B and A are the most important. So even if you cover module B and module A, you are going to score even more than 60%. You can score more than 60% easily if you go for module B and module A. So I told you about that in case of Basel, we are having the three pillars: minimum capital requirement, we are having the supervisory review process, and the market discipline. Further, I told you that in case of minimum capital requirement, we talked about the two capitals: tier 1 capital, which is said to be the going concern capital, and tier 2 capital, which is said to be the gone concern capital, right? And further, I told you about the different capital which need to be basically maintained by the banks, right? And it is mandated by the central bank, that is the Reserve Bank of India. Further, I told you that in case of the second pillar, that is a SRP, supervisory review process, we are having two main measures. One measure is related to ICAAP, that is internal capital adequacy and assessment process, and the second one it's related to the SREP, supervisory review and evaluation process. The third pillar is related to the market discipline, which supports both the pillars 1 and pillar 2, and it basically emphasizes on the transparency that related to the disclosures that the regulated entities need to maintain, right, when they are basically following the guidelines. Okay, so pillar 1 is related to the minimum capital requirement. I told you for the credit risk we are having three approaches: standardized approach, then we are having two approaches related to the internal rating based approach. One it is foundation approach and the other one it is the advanced approach. And for the capital for the market risk, we are having further two approaches: standardized approach, maturity method, duration method, and internal model method is there. And for capital, if you want to maintain for the operational risk, we are having three approaches: basic indicator approach, standardized approach, and the AMA, that is a advanced measurement approach. In case of BFM exam, you may be asked the numerical related to these two approaches, that is basic indicator approach and the standardized approach. Now let's move further. Now, as per the Basel 1 Accord, you were to maintain the capital for the credit risk and the market risk. Previously, it was related to the credit risk only, right? But thereafter, in 1996 amendment, the market risk was also added up. But later on, as per the Basel 2 Accords, the operational risk was also added to it and the minimum capital is to be maintained. I already told you that the capital is to be maintained on based upon the risk-weighted assets. So as per the Basel guidelines, we are to maintain the capital for the credit risk, market risk, and the operational risk. And what will be the formula? The formula is very much simple. So if I tell you about the CAR, that is a capital adequacy ratio, it would be equal to the capital that we maintain, that is tier 1 capital plus tier 2 capital divided by the total risk weighted assets, right? So this is going to be the formula. So capital would be in the form of tier 1 capital or the tier 2 capital, and for the denominator component, I'll be having the risk weighted assets related to the credit risk, related to the market risk, and the operational risk. Now first of all, let's talk about the capital charge for the credit risk. So whenever we are talking about the capital charge for the credit risk, there are two approaches. One, it is a standardized approach as per which the risk weights are fixed by the supervisor, means the regulator, means the Central Bank of India, means Reserve Bank of India will be fixing the risk weight percentages for different category of the assets, and we need to use the particular risk weightage asset percentage, and we will be calculating the risk weight, and for the based upon that we'll be maintaining the capital. Minimum capital will be maintained based upon that. So we'll be going for the example and you'll be able to understand each and everything. So we are having two approaches. One, it is a standardized approach, and the other approach, it's the internal rating based approach. One, it is a foundation approach, and the other one, it is related to what? Which was the other approach? So we were having two approaches. One was the foundation approach and the other one was the advanced approach. Is that clear? Now, let's move further. Now, we are going to learn about the standardized approach first of all. Now, in case of standardized approach, I already told you that these risk weight percentages are fixed by the Reserve Bank of India. Now, let me tell you the idea related to it, that how it is being fixed, right? So let us take the case that for the different asset categories, Reserve Bank of India has fixed the weightage percentages. Like, let's say if you are maintaining the cash balance with the Reserve Bank of India, the risk weightage percentage is 0 if you're maintaining cash balance with Reserve Bank of India. If you're maintaining the balance with the other banks, the weightage percentage is 20%. If you're giving loan to PSU, the risk weightage percentage is 100%, right? And if you're basically giving the loan up to rupees 1 lakh against the gold or silver ornaments, it is 50%, right? So it is different for the different category of the asset. Now let's say in case I have placed 1 crore of the deposits with the Reserve Bank of India. So it will be multiplied by 0%. So it will be 0. So 0 capital is to be maintained for that. If I have basically placed deposit with other banks, let's say I have placed 1 crore deposit with other banks, in that scenario, I'm to multiply it with 20%. So it will be 20% of 1 crore, that is 20 lakh rupees, right? So risk weightage assets would be equal to 20 lakh rupees. Further, let's say case I have given 1 crore of the loan to the PSUs. Now in that scenario, it will be 100 lakh, that is 1 crore itself. And further, if I say that I have loan up to rupees 1 lakh against the gold and silver amounting rupees 1 crore, then it will be having the risk weighted asset would be equal to 50 lakh. So if I'll be taking the total of the same, it will be coming out to be 170 lakh, right? 170 lakh, and the minimum capital in India is to be maintained at 9%. So minimum capital that we need to maintain would be equal to 170 lakhs multiplied by 9%, that is 15.3 lakh of the capital is to be maintained, right? This is as per the standardized approach. This is as per what approach? This is as per the standardized approach. Is that clear to you? Now, after that, we are having the other approaches. The second approach, it's related to the internal rating based approach. It is an internal rating based approach. So it is said in the same case that in the case of the standardized approach, the banks are required to slot the credit exposure into the different supervisory credits category, right? And further, what's of the risk weightage asset percentage is given. Based upon that, you'll be calculating the risk weighted asset, and after that you are going to calculate the minimum capital required. The second one, it's related to the internal rating based approach. Now what is the scenario in case of the internal rating based approach? We are having the two options. In case of IRB, I'm having two options. One, it is foundational internal rating based approach, and the second one, it is advanced internal rating based approach, right? Internal rating based approach, right? So these are the two different scenarios in case of internal rating based approach. Now this is actually based upon bank's internal assessment. Now the potential will be there that we can be having more risk sensitive capital requirement. That is basically, that was a major limitation of the Basel II. That was a major limitation of the Basel I and Basel II, that we are not following the risk sensitive criteria, right? Now in these approaches, the bank is given much more freedom that they can be having the internal assessment, and based upon that they can be looking into the things that they can be calculating, computing their own capital requirements for each particular exposure, right, before computing the risk weightage asset, right? Now in the standardized approach, we were focusing upon risk weighted asset. Now in this case, the focus is not upon the risk weighted asset, but it is focused upon 4 different parameters, and those parameters are what? In both of the scenarios, there are 4 parameters. One parameter is related to the PD, that is the probability of default. The second parameter, I'll be explaining all the four parameters, do not worry. The first parameter is PD, that is probability of default. Second parameter is LGD, that is loss given default. The third parameter is EAD, that is exposure at default. And the fourth parameter is related to the maturity, represented by small m, right? So these are the four parameters: PD, probability of default; LGD, loss given default; EAD, exposure at default; and M is the maturity, right? So when I'm going to talk about the probability of default, it particularly measures the probability that what percentage of the probability is there that a borrower can default over a given time horizon. Let's take the case that I'm talking about 6 months of the tenure. So what is the probability that over the 6 months of the time horizon, the loan may get defaulted, right? So that's a probability of default. That is the probability of default. The second one, it is loss given the default. Now it will be going to measure what? It is going to measure the proportion. Now in case of the LGD, it is going to measure the proportion of the exposure that will be lost if the default occurs. Now first one, it was related to probability of loss that we are going to calculate, that may happen, that a borrower may default over a given time horizon. But in case of loss given default, we are looking at the proportion, that what proportion can be the exposure if the default happens, right? So what percentage or what proportion of the exposure may be there, may be lost if the particular default occurs, right? That is LGD. The third one, exposure at default, that measures the amount of the facility that is likely to be drawn in the event of default. That if the default event is there at the point, third point, we are already considering that the default is there. We are just considering that the third point is going to quantify, it is going to measure the amount of facility that would have been drawn, that is exposure at default, right? Further, maturity measures what? It measures the remaining economic maturity of the exposure. Remaining economic maturity. So let me write over here. It measures remaining economic maturity. Right? Is it clear so far? No. In case of the internal rating based approach, it is not the case that all the four parameters are to be calculated by the bank itself, right? It is not the case. So the IRB approach never allows the bank that they can be determining the elements so as to calculate their own capital requirement. The risk weights and the capital charges would be determined through the combination of the quantitative inputs. So these are the quantitative input parameters. These are the quantitative input parameters which will be provided by the bank, and those will be formulated by the specified committee, right? Like under the FIRB, that is a foundation internal rating based approach, the bank will be providing the, in case of FIRB, I'm marking it with purple, right? I'm marking it with purple. The FIRB, in the case of FIRB, the bank will be providing the estimate related to the probability of default. So it will be covering the probability related to default, right? And for other risk components, like for other three components, for LGD, EAD, and M, it will be depending upon the regulator. It will be depending upon the regulator. But in the case of AIRB, the bank will be providing much more inputs. Like it will be giving the probability of default. It will also be giving the loss given default. It will be giving the EAD also, and it will be giving the maturity also. So in case of the advanced internal rating based approach, the bank will be giving the assessments or will be giving the estimates related to all the four parameters. Is that clear? So that is what? That is a internal rating based approach. I hope that you must have understood. Right? Now, let's have a look at this particular point. So there are four core risk parameters. One, it is related to the probability of default. I already told you that the probability of default is what? It is a measure that the time period over which, the time horizon over which the borrower will default. That is a probability related to it, right? And when I'm talking about the LGD, it measures the proportion of the exposure. It what measures? It measures the proportion of the exposure that will be lost if the default occurs. We are just thinking that if the default occurred, this proportion of the exposure will be lost, right? That is loss given default. If default occurs, then this proportion of the exposure will be lost. But when we are thinking about the EAD, we are thinking about that the exposure default is already there. We are thinking about the amount which was drawn when the default occurred, right? That was the exposure at default. And M would be related to the maturity, that is a remaining economic maturity. That is a remaining economic maturity. Is that clear? Right? So in case of the FIRB, the PD is estimated by the bank. All the other parameters are estimated by the supervisor. But in case of the AIRB, the bank provides its estimate related to all the 4 parameters. That was it. That is all about it. After that, now let's have a look at the components of the regulatory capital. I already told you we are having the capital, tier 1 capital and tier 2 capital. Tier 1 capital is said to be the going concern capital. We say it to be the core capital. And it is having 2 components, common equity tier 1 capital and the additional tier 1 capital. Common equity tier 1 capital is said to be CET1, common equity tier 1 capital. Additional tier 1 capital is said to be AT1, right? Further, tier 2 capital is said to be the gone concern capital. Also, it is said to be the supplementary capital. It is also said to be the supplementary capital. Now, there is a very good philosophy in general also, that in good times, if you save money, then it is going to help you in the bad times. Same is the case with the Basel III guidelines. So there is a conservation buffer, and we say it to be capital conservation buffer, and that is CCB. CCB, right? So capital conservation buffer states that the banks are to maintain 2.5% of the extra capital in their good times that can absorb much more losses in the bad times, right? So that is a CCB, that is a surplus capital which is to be maintained, and it is mandatory. It is mandatory. Previously, it was the case that the banks were to maintain this CCB 2.5% in 4 different tranches of 0.6 to 5%. But now it is mandatory for the banks to maintain 2.5% of the capital. Is that clear? Right? Now, let's have a look at the table here. So I told you already that the BCBS says that the minimum these much guidelines are to be maintained, but the regulators may ask their country banks so as to maintain the stringent guidelines also, right? So that's also the case in India, that in general the guideline related to CET1, that is a minimum minimum common equity tier 1 capital that is to be maintained as per the BCBS, that is Basel Committee on Banking Supervision. It says 4.5% is to be maintained, but Indian regulator says no, you have to maintain at 5.5%. But all the ratios are all same, right? For 1.5% for AT1, and tier 2 is to be maintained at 2%, right? So the minimum requirement related to the capital adequacy ratio in general for international banks, it is 8%, but for Indian banks it is 9% because there was 1% increase in case of the CET1 capital. Is that clear? Why I am telling you these things? Because you may be facing the cases where it is said that an international bank is maintaining the Basel III guidelines or maintaining the capital adequacy ratio. In that scenario, you are to think it from that particular point that the international bank, which is not in India, right? Definitely they will be following 8% of the minimum capital adequacy ratio, not the 9%. But if it is not mentioned at what bank, then we will simply be thinking it's a bank in India, right? For the numerical point of view, for the case study point of view, I'm telling you. While we will be solving the questions, I'll be telling you in detail also, right? For CCB, the same percentage, 2.5% is to be maintained, and the 2.5% is to be maintained in the form of the CET1 component. So let me tell you that these are the different capitals, and different capitals belong to the different capitals are having the different components, right? Like CET1 would be having the different components. Additional tier 1 would be having the different components. You'll be learning these all very shortly. Right after this, the next topic is related to the components of these capitals. So then you'll be understanding. But right now, just understand this point that the CCB is also maintained from the same components from which the CET1 is made out of. Right? So CET1, extra CET1 is to be maintained 2.5%. So minimum CET1 would be equal to what? In case of India, it will be 5.5% plus 2.5%, that is 8%. Is that clear? And the minimum capital which is to be maintained, that is a minimum capital like total CAR plus CCB. For India, it is to be maintained at 9% plus 2.5%, that is 11.5%. For other banks, it is to be maintained at 8% plus 2.5%, that is 10.5%. Is that clear? Are you clear with this thing? So that is the minimum capital requirement. So this particular chart is very much important. If you have understood the point so far, and if you have been liking the video, kindly please do press the like button, give this video a like, and do not forget to subscribe to the channel if you have not subscribed so far, and press the bell notification icon too, so that you get updated whenever we upload the new videos. Right? Now let's move further. So the CET1 ratio would be equal to what? Like I told you simply that the capital adequacy ratio, CAR, would be equal to what? Total capital, that is tier 1 capital plus tier 2 capital divided by risk weight assets for different category of the assets, like for the credit risk plus market risk plus operational risk. This is the capital adequacy ratio. And if we are to calculate the tier 1 ratio, if we are just to calculate the tier 1 ratio, then what would be it? Tier 1 ratio would be equal to tier 1 capital, that is tier 1 capital. Now the different components of the tier 1 are equal to CET1 plus AT1 divided by risk weight assets, total risk weight assets, again for credit risk, market risk, and operational risk. Is that clear? Now what if I am to calculate the CET1 ratio? CET1 ratio, that would be equal to what? That would be equal to CET1 capital divided by the total risk weight assets for all the three risks: credit risk, market risk, plus operational risk. Now this only thing is mentioned over here. So CET1 capital ratio would be equal to CET1 capital divided by the total risk weight assets multiplied by 100. Right? Same goes for the tier 1 capital, same goes for the CAR. The another name for the CAR is CRAR. The CAR is capital adequacy ratio, CRAR is capital risk weight asset ratio. Capital risk weight asset ratio. Right? Now, let's have a look at the components of the CET1 capital. Very much important. This topic is very much important because this can get you 5 to 7 marks very easily. 5 to 7 marks very easily, because one case study you'll be definitely finding in the exam related to the components of the tier 1, tier 2 capital. Definitely, for sure, it will be there. In any form, it can be there. So in case of CET1, I can simply be telling you there are total 10 components. There are 10 components related to it, and you should be cramming it if you cannot memorize it, right? Otherwise, it is very much easier to memorize it, but you should be cramming it if you are not able to memorize it. Like, first of all, it's related to paid up equity capital. I already told you about the paid up capital. Like, let's say case the shares are issued. When the company is issuing the shares, like you subscribe the shares, and when the shares are allotted, you pay the money related to shares to the company. Let's say the case that the company share is having the face value of rupees 100. The face value of share is rupees 100, but it is market. It is in the market. It is listed at rupees 153, right? The company is having the face value of the share equal to rupees 100, but in the market it is floating at rupees 153. It means rupees 100 is basically the paid up value. It is a paid up value of the share, and 53 would be going into the account of the share premium. Share premium of the general shares. Now there are different types of shares. We are having the preference shares. We are having the general equity shares. In the case of CET1, we are talking about the general equity shares. We are talking about the general equity shares, right? So paid up equity capital would be the component related to the face value. It will be simply be given to you, right? That the paid up equity capital. But make sure we are just talking about the paid up equity capital. If it is mentioned like the authorized capital is not the component of the CET1, because authorized capital is the maximum amount of the capital that any company or banking company may be raising in the market, right? That's another point. So you should be understanding the difference between the authorized capital and the paid up capital. Paid up capital showcases the actual amount which has been received and paid by the company and which has been paid by the shareholder, right? So that is the first component of the CET1. Further, the statutory reserves, any of the statutory reserves, if it is there, so that will be the component of the CET1. Any disclosed reserve, disclosed free reserve, let's say case you have made a reserve, it's a free reserve available for any of the purposes. Now in that scenario, it's also the component of CET1. Capital reserves, let's say the case you have sold the goods, you have sold the capital assets and you received the money from it, right? So that will be forming the capital reserve. So that will also be a component of the CET1. Other than that, the stock surplus, I told you about the share premium na, that will also be a component of the CET1. So paid up equity capital and the share premium, both are the component related to CET1. Here I'm talking about the general share, normal share we can say. General share I'm talking about. I'm not talking about the preference shares here. Those will be discussing in case of the AT1 and the tier 2 capital, right? That's why I'm differentiating between these two. Further, whatsoever the balance in the profit loss account was there in the end of the previous financial year, that will also be part of the CET1. Current year profits can also be the component of the CET1, but there is a condition that quarter to quarter basis, the incremental NPA should not be deviating more than 25% for any of the quarters. Then it can be the part. It should not be the case that previously your NPAs were 100 crore and from one quarter to another quarter it switched to, let's say, more than 25%. Let's say it was 126 crore in the next quarter. Then the current year profits cannot be a part of the CET1 capital, but otherwise, if it is in limit and lesser than 25%, that quarter to quarter basis, if the incremental NPA growth is not more than 25%, then even the current year profits can be a part of what? It can be a part of the CET1 capital. Is that clear? Further, revaluation reserves, very much important. Previously, it was said to be a component of the tier 2 capital, but now it's a component of the CET1 capital. Now the revaluation reserves, let's say previously your asset was worth amounting rupees 2 crore in the year 2002, but now when you revalued it, it is somewhat around 20 crore. Now there is 18 crore of the value increment in that, right? And now you can be considering this 18 crore value as your CET1 component, but at 55% discount. So we are to discount it by 55%. It means 18 crores minus 55%. So it is 18 crore minus 55%. That is 8.1 crore value can be considered under the CET1 component. Is that clear? I'm just giving an example related to it. And other than that, the ninth component is what? Let's say case you are having the foreign currency with you, right? In your books, you are having the foreign currency. And whenever we do prepare the balance sheet, we do translate the foreign currency amounts to the Indian currency. And let's say case there was an appreciation when you translated the point. So that particular appreciated amount goes to the foreign currency translation reserves. So that particular amount can also be considered as per the CET1 component. That can be considered, but at 25% discount, it will be considered as the CET1 component. And the last component, it is related to the DTA. That if you have any deferred tax asset, you have paid the amount or you are basically eligible to get some amount from the income tax department or authority, right? In that scenario, that can also be considered as a component of the CET1 capital. So there are total 10 components which are there in case of the CET1 components, right? CCB is also made out of these 10 components, right? First component is paid up equity capital, statutory reserves, any disclosed free reserves, capital reserves which are there from sale of the capital assets, stock surplus if any, balance of the profit and loss account from the previous financial year. Current year profit loss account can also be reckoned on quarterly basis, but the condition is that quarter to quarter basis NPA should not be deviating more than 25%, then it can be considered. For the revaluation reserves at 55% discount, foreign currency translation reserves at 25% discount, and deferred tax asset can also be component of the CET1 capital. Is that clear so far? It was a very important session, and let me assure you that we'll be covering the case studies, we'll be covering the numerical component, we'll be telling you about the previous set questions, and that all content will be available in our application. So simply download the application right now, which is available at the link https://iibf.info/app, and definitely it's going to help you a lot. And see you again in the next video. Happy learning.